Hello and good afternoon, everybody. Well, nearly afternoon. We have 1 minute to go. Just wanted to ensure that everybody is able to join and get your audio settings as you need to for the webinar. We'll begin shortly. We'll just have another minute or so before we actually begin. We can still see that some people are still joining. In terms of housekeeping, just whilst we begin, we do have a Q&A function that is available for you. So if you do have any questions as we move through the webinar, just use the Q&A function. You should be able to see that in the toolbar at the top, where if you answer any questions as they pop into your head, pop them into the Q&A there, and we will aim to answer those at the end of the session. The session will also and is being recorded, so if you needed to revisit the session at any way after the live session today, then we will distribute the link for you, and you'll be able to revisit as you need to. So welcome everybody, and thank you ever so much for joining our first broker webinar, one of which we aim to regularly do. And we'll be doing these. In fact, I think we would like some feedback from you as to how often that you would like these, to ensure that we can bring necessary education to you guys on things that are happening in the insurance world. And as you can obviously know from the invitation today, we'll be looking at navigating commission and how do we ensure that we are compliant, including us at Protect and you guys in the distribution chain, and how do we ensure that we are able to deliver fair value. So for those who've just joined, just to echo, you are muted, your cameras are off, it is webinar format. If you do have any questions, please pop them into the Q&A function and we'll answer those as we move through. So as your host today, my name is Matt Owen James. I'm a learning and development business consultant. I've worked in the insurance industry for 17 years. I've worked in L&D as an L&D specialist for the last 10 years, various different training deliveries that I do, including technical insurance, regulatory and compliance, CI revision training sessions as well, to sort of get people educated and qualified, as it were, from that perspective. And joining me, I also have Jim Dart. Jim Dart is the Managing Director of Dart Compliance Limited. 48 years experience. And Jim, if you wanted to sort of introduce yourself.
Hi there. We're a specialist general insurance compliance advice company, and I'll be looking today at some of the regulatory issues around fair value. We look after about 150 general insurance brokers, MGAs, small insurers, and other insurance participants.
Fantastic, thank you, Jim, and thanks for coming on board and helping to deliver today. So, as you guys have probably seen from the registration, what we are going to be looking at is 3 key takeaways from the session today. First thing which I want us to do is to just simply define the core principles of what an unfair relationship looks like. And what we're going to be doing is using the Supreme Court ruling on motor finance agreements. It's hot in the news. Martin Lewis is consistently on about it when it comes to his shows. But there are learnings from there, which is the reason why we are using this as the foundation to help us understand what that actually means, so that we're able to then connect what that legal precedent set and how then the FCA are looking at it from that regulatory requirement under consumer duty, which Jim is going to hand over. Well, I'm going to hand over to Jim to do. And then finally, I want us to be able to articulate how our sort of partnership model, based on that, how a partnership model will then create that stable, compliant framework so that we can work more collaboratively, I guess, in the future at Protect Commercial. So in order to get there, we have 3 key areas which we're going to be exploring. So I'm going to sort of kick off really, and we'll be looking at unpacking what that Supreme Court ruling on those commission payments were actually all about. We're going to be looking at something not just necessarily motor finance, but we're also going to be looking at something which was what seemingly, at least anyway, seems to be unconnected to motor finance agreements, but it is something which we definitely need to look at because it has now changed how these litigations are ultimately funded. And what we're going to be then concentrating on is the two areas, particularly around car finance. I know that we don't do that, but the same principles is what we need to adhere to there. Then we're going to hand over to Jim, and Jim is going to talk to us about the regulatory reality and understanding what all of that actually means for us now as, first of all, insurance brokers that protect commercial, but also you guys in the distribution chain of those insurance products as well. And then finally, I'm going to be then covering off our new sort of partnership model and our commitment. And as I said, for those who've just joined as well, if you do have questions, please pop them into the chat. So, unpacking the Supreme Court ruling on those payments. Now, I want to begin and sort of kick off this particular part of the session, really looking at where it all began. As I said, particularly within the motor insurance industry, something what is known as CDAs or discretionary commission agreements. For many, many years, they were standard practice, and how they worked were fairly simple. Ultimately, it meant that the motor, when a customer goes into the car dealership to wanting a new car, they needed finance to do that. Ultimately, the dealer then sort of acted as that credit broker, connecting the two. Sometimes from a panel of finance providers as well, but often they would have a preferred one or two. So the lender under the DCA, the lender would ultimately give a customer from a range of different products that they may have a range of interest which they could offer. And ultimately, crucially, the reason that it was discretionary is because the dealer had the opportunity or the discretion, I guess, to choose the final rate within that specific range. Of course, the higher the rate or the higher the interest rate was, the more commission that the dealer received from the lender. Now, I'm sure that we're aware that obviously that creates an obvious conflict of interest, but the customer naturally assumes that the dealer is working with them to get the best deal. But in reality, the dealer was getting financially incentivized to try and push for that higher interest rate in line, of their own targets and maybe even their own pockets. And this is a key piece of information that was very rarely, if ever at all, actually disclosed to the customer. Now, what we also have to take into account is a case for PACCAR Inc. versus Competition Appeal Tribunal. At the time that all of these DCAs were sort of going through and it became a bit of a light to being dealt with the smaller courts, it was escalating, of course. Sometimes, as we're going through there as well, is a very different, and as I said earlier on, a seemingly unrelated case was going through the Supreme Court and was working its way, it was working its way through the courts and then to eventually arrive at the Supreme Court. And this was the case of PACCAR Inc. Now, crucially, this case had absolutely nothing to do with car finance. The case was around major price fixing scandals in truck manufacturing industry. So on the face of it, it was completely different, and it was completely different to products and different industries. But the PACCAR case itself wasn't necessarily, as I said, around those particular areas. It wasn't necessarily about the conduct, which is why it was going through the courts. It was actually around litigation funding. When we think about litigation funding, specifically on how these huge mass legal claims against large corporations were being financed, bringing that massive legal claim against those corporations cost millions of pounds, sometimes in the tens of millions, specifically in those legal fees. Now, way more than what a single person is ever able to afford to pick up. So to try and solve this, there are specialist companies called litigation funders, and they kind of step in these circumstances. Ultimately, what they do is to act as the financial backer for those lawsuits. Now, they'll cover all of the legal fees, they'll cover the lawyers, expert witnesses, court costs. And in return, if the claim is successful, then they take a percentage of the damages that are won. Ultimately, it's a no win, no fee type situation for the consumer. But the funder is taking quite a big risk because if the claim then falls, then ultimately they lose their investment. So that funding model was the very engine that was powering all of those mass claims against those motor finance companies. And without those funders, then those claims simply couldn't go ahead. Now, what actually happened during the court case? They made a very clever argument. And what they sort of looked at, they didn't just fight the price fixing accusation head on. They went they went after something much more fundamental, which is why we're looking at it in the session today. What they did was to challenge the legality of the funding agreement itself. Now, in law, there are very specific categories for those no win, no fee arrangements. They're called DBAs or damage based agreements. And to protect consumers, DBAs are very, very strictly regulated by the government. The litigation funders, for their part, had always argued that their agreements were called litigation funding agreements rather than DBAs, so LFAs instead. Now, these were somehow different to DBAs, and therefore they didn't need to meet those strict regulatory rules of the DBA. But the defendants argued that if the funder's payment is a percentage of the damages that are recovered, then regardless of what they're actually called, the substance is what we should be looking at. Regardless of what we label it, the substance itself is still a DBA. And if it didn't comply with those DBA regulations, then therefore it should be illegal and therefore unenforceable. Very technical when it sort of got through to courts, but still a very powerful argument. Now, what actually happened? Now, it was agreed that the Supreme Court agreed that, yes, ultimately, we should be looking at the substance. And therefore, as a result of it, potentially rendering those LTAs not what they were actually supposed to sort of be. It was a bombshell for the entire UK legal world. They said that we need to be focusing on the substance of that agreement, and ultimately that means that they agreed with the defendants. So they ultimately ruled that if an agreement gives a funder a payment calculated as a percentage of the damages, then yes, it is, in the eyes of the law, a DBA rather than an LTA. So it instantly rendered that funding agreement for most mass consumer claims across the country, not just this one, and that included those billions of pounds worth of motor finance claims that we talked about, unenforceable. Now, it didn't mean that those commission claims suddenly had no merit. It just meant that the primary mechanism for funding them was ultimately broken. And ultimately, the funding source behind it had now ceased. So it now creates a massive obstacle for consumers, and they had potentially valid claims, but suddenly no practical way to pursue them through the courts unless they funded it at their own expense. Now, what we also have to sort of think about as well when it comes to that is because it was so chaotic, then a combination of just sheer scale of the potential harm to consumers was a key factor in prompting the FCA to then decide to step in. So the FCA have now opened its consultation period for a period of 6 weeks. You can see the date on the screen there. And ultimately, the whole purpose around this is to propose a redress scheme for those motor finance commission complaints. The consultation, it's a very important step towards defining how the compensation will actually work, who will qualify, and when payments might begin. But the scheme hasn't been finalised yet. Consultation closes on the 18th of November, where we'll then start to look at what that actually means from the FCA's perspective, what their consultation period is. Feedback on whether they will actually launch the redress scheme is due to be accelerated as well for the 4th of November. So we've only got a couple of days, I guess, to find that out. The FCA suggests that their scheme will start in spring of 2026, with hopefully initial offerings from those lenders happening from July and payments therefore shortly after. So what can we learn from all of this? So I'm going to hand over to Jim, and we're going to be talking about the regulatory reality of it all, particularly around the commission and really looking at consumer duty. Over to you, Jim. Thank you so much.
Thanks very much, Matt. Okay, so a key element of the motor finance court case, and there were three decisions made in that, two on behalf of lenders, and this was unsurprising, really. A key element was, did the used car salesman owe the customer a duty as agent? So was the used car seller an agent for that person in purchasing the car and therefore in purchasing the finance? And unsurprisingly, the court decided that used car salesmen don't have a fiduciary duty to the people who are buying cars. So those failed. The one that succeeded was in relation to the agreement being unfair. And it was deemed unfair because of the amount of commission that was being paid to the motor dealer, which was not disclosed. And this is really important, the disclosure part. Now, the FCA rules changed in 2021 in relation to discretionary arrangements and banned them. So a lot of these cases will go back far before then, but they have remained in place in the insurance industry. So although they were banned on those types of finance, it's still a case where an insurance intermediary using one or two premium finance providers may be able to flex the rate. So this is something that the FCA are in the middle of a consultation, a market study on premium finance. Most importantly, however, the reason those cases failed was because there was no fiduciary duty to the customer. And that's simply not the case in insurance or as a mortgage broker. You have a legal fiduciary duty to your customers. This requires that you report to your customer. And that's the reason why previously, in relation to insurance, there was very little in the way of disclosure rules, because the common law principle and the principle under law of agency was that you had to tell the customer what you were earning anyway, albeit that in certain cases, so for normally for commercial customers, that information was on request. It wasn't necessarily disclosed. Well, since before the court judgment, premium finance providers have changed to a hard disclosure requirement in general. There's one notably that doesn't, purely because these things have arisen through a lack of understanding of the customer about how the transaction is being remunerated to the agent. So, as an insurance intermediary, what now has to happen is that the broker will say you're paying by premium finance. This is the interest rate that you're going to be charged. This is how much commission we will make in pounds terms, and that will be documentation from the lender normally. And then in their own documentation, they have to say what the amount of uplift they've applied is. So if the buy-in rate for that finance is 8%, 7% or whatever, and they're charging 3% on top, they'll have to say, and we earn 3% of this. And it's all about being transparent. The FCA reasonably relaxed in what intermediaries do, as long as there's transparency and the customer understands it. Now, let's just cut that back slightly, in that the four outcomes for Consumer Duty involve products and services, price and value. Well, you'll be aware, if you're in the mortgage industry, you'll be aware that the products are reviewed every year. There's product governance rules which are very involved, and in the insurance industry, insurers contact brokers and ask what costs they're adding. That will include the amount of uplift on premium finance. It's the amount that they receive from add-ons sold alongside the primary product, which could be things like legal expenses. And it's also the commission. They're looking at the commission rate that the intermediary is being paid. This has resulted, since the Consumer Duty came into force a couple of years ago, generally speaking, with commission rates being reduced, sometimes reasonably significantly. So for property insurances, commission rates may have reduced as much as 10, 12.5, even 15% from prior to Consumer Duty. So other insurances, they might have gone down 5%, 2.5%. The commission rates. But what's become clear is that everyone throughout the distribution chain is considered in the product governance review. The FCA are suddenly interested in who's being paid what. Now, the chain, this has meant that, for example, a product which is placed in the Lloyd's market might come through a Lloyd's broker down to the wholesale broker, who might then sell on to a retail broker. It might be the Lloyd's syndicate, then a Lloyd's broker, and then a retail scheme holder, cover holder. The Lloyd's broker is being squeezed on these. It's not something Lloyd's want, but what's happening is the regulator is saying, well, what do they do? What do they add to the process? What's the value of them being there? Now, there will be some value in that case, because they will be providing certain guarantees in terms of premium to the underwriters. There will be hopefully managing accounting. So there's some value there. But we've seen Lloyd's brokers who would traditionally take 2.5% of the commission being squeezed back to 1%, where they don't have much of an input. This absolutely feeds down the distribution chain as well to introducers and sub-agents. So if a sub-agent is involved with a provider, then you're looking at what they do for their share of the commission. An interesting point that the FCA raised during lockdown and the year after, so in 2021, when property premiums were rising exponentially because of the difficulty of building goods and equipment and workers, the FCA said that a broker shouldn't earn more commission simply because the premium had gone up. Well, of course, the commission is based on a percentage of the premium, so it's quite difficult. And the FCA didn't really understand that there's not very much a broker can do. I guess they could rebate some commission to the customer, but if they're paid by installments, that's quite difficult. Didn't understand that the premium went up and therefore the commission went up, and there wasn't much that could change about that. You can't go back to an insurer and say, oh, give me 2.5% less on this one. But it did show that the FCA are very focused on the value that's being delivered. Lots of intermediaries look to offering additional services for that additional commission. And that's really what they're looking for throughout the distribution chain. So if we look at introducers, an introducer provides and demonstrates a service when they introduce that business to a relevant provider, relevant broker, who is able to offer a product that meets that customer's needs. that introducer may not be involved in the process the following year. So one has to look at what value they provide to the service the following year. Now, while we're looking at the outcomes here, you'll also be aware that customer understanding is a major problem for the FCA in insurance. Lots of insurance policies, although they may years ago have been updated, still contain terminology that's simply not understood by customers. And we say to brokers all the time, any condition on a policy which starts with the sentence, "It is a condition precedent to liability that," is not being understood by the policyholder. They don't know what that means. You may have seen a week or two ago that there's been a super complaint by which the Consumer Association to the FCA. Part of that relates to customer understanding, and they are saying, quite rightly, I have to say, that in most insurers have not reviewed their policy wordings in line with Consumer Duty, and they are still misleading and misunderstandable. This is all this has done is placed additional onus on the broker, because the broker, under Consumer Duty, has to evidence that they've provided the relevant tools and information for the customer to understand. That links in, obviously, to consumer support. But interestingly, last week, an FCA speaker was saying that their focus has changed. Originally, the focus of Consumer Duty was understand what the outcomes are supposed to be. We want to see a mechanism in place for you to measure them. It moved on to very much a focus on vulnerable customers, which you notice I haven't really mentioned at this stage. And it almost became fixated on identifying vulnerable customers and how you did that. It's moved on from there. We're now looking at evidence that firms are achieving and improving outcomes, not just for vulnerable customers, but for all customers. And this moving piece by the FCA, this constant improvement by the FCA, is increasingly sitting around corporate governance. They want proper evidence that customers are being treated better. If policy documents, and I saw one last week, policy document was 195 pages long. The policy summary was 1 page long, which had been provided by the broker, which didn't detail things that weren't covered. This is all about products meeting the target market. The value of a product that's cheap isn't necessarily good value. If it doesn't pay out, it's not good value. Then again, it wasn't suitable. May not be suitable for the target market. All of these things have combined to come back to the broker to say, right, I'm an insurer. Here's my product for this particular market. You have to tell me, Mr. Broker, if it's not right. If it doesn't meet the target market's needs, you have to tell me. Now, whilst an insurer has some responsibility for that, ultimately, the broker has to make sure he understands it. He points out significant terms, conditions, and exclusions. He makes sure that it's not being sold outside of the target market. So it's not a case of sliding something in that because the rate looks good, but it's not really fitting that policy. And most of all, he is the first point of contact for the customer if something goes wrong. So what we have then, if brokers are not doing this, well, we know that the first direct financial liability will be via the Financial Ombudsman Service. And bear in mind, the Ombudsman Service is not restricted by legal precedent. The Ombudsman Service settles claims on what they think is fair. So customer redress will come in there. Matt's mentioned the redress scheme coming in for motor finance, and that will be so that these things don't turn into another PPI which lasts 8 years and the ombudsman gets 8 million complaints to deal with. So it's to try and streamline that and make sure that customers are dealt with properly. you can end up the broker, and this will also be for sub agents. If you're taking the responsibility for saying yes, this policy is suitable, all of these elements will apply to you because the consumer duty applies throughout the distribution chain. And direct regulatory action from the FCA can be very time consuming. It can be very, very stressful. You noticed I added an extra very into the stressful sentence because, frankly, the fact that they're just talking to you, and that's what they do now. So the FCA have spotted that it's just as easy to say, oh, can we jump on a quick Teams call, as it is to send you an email. Now, the problem with that is they will quite happily sit there while you chat, listening to you, digging the hole. They will wait for you to stop digging. And if you don't stop digging, they'll happily let you drop yourselves in it, or indeed any broker, and then they'll jump on that. And I'll give you an example of how that might happen. We had a client who was on a team call because of an issue with regulatory reporting. And during the course of the discussion, she mentioned she got married 6 months earlier and just carried on chatting. And at the end of the sort of chat, she said, the supervisor at the FCA said, so have you changed your name then since you got married? And the broker said, yeah, I have. She said, well, it's not changed on the register. So how would a customer know that you're authorized? Now, that led into 7 months of various regulatory reports and specific reporting for that firm because they just started digging and they don't stop digging. Obviously, if firms get fined, there's massive reputational damage. It's all over the press, always all over the press. But it is time consuming. That particular firm, which started with a name change, well, that hadn't been reported to the FCA. They were talking about, well, do you not understand the principles for business? Do you not understand principle 11? You have to tell us things that we might reasonably expect to know. And it really got very, very involved, such that we ourselves had to do a full audit on the firm. The firm had to provide 12 files per month for 3 months to the FCA for them to audit. Now, in fairness, they didn't find anything wrong, but it took 7 months before we were able to shake them off. So the regulatory burden that goes with consumer duty, brilliant. Nobody's going to argue with that customers should get a good deal and understand what they're buying. But the regulatory burden for that is massively, massively increased, as I'm sure those of you who are regulated yourselves, you will be aware. I think back to you, Matt.
Thank you so much, Jim. I think it's really interesting. I've seen the super complaint as well from the FCA about motor insurance specifically, wasn't it? And about the cost of it, and linking back to what you said about the value, what is it that is actually being covered and understanding. So, so thank you.
Just to pick up on that, Matt. So it's household and travel they're particularly picking up on. But again, where we're talking about people shooting themselves in the foot, the FCA received the super complaint, and the same day their response was, well, yeah, we've known about this since March. Not that they've done anything about it, but they've known about it. So they're quite capable of dropping themselves in it as well.
Yeah, oh, absolutely, absolutely. So thank you, everybody. I'm just conscious of time. So just very short before we conclude today, and I just want to finish off today's webinar with just summarising our new approach to how our working relationship will work moving forward. Specifically in sight of that, and really looking at, I mean, Jim's already mentioned it, and I know that you know anyway. The change in the terms of business, in terms of the commission from renewal, and now we know the reasons why. But following everything that we've kind of talked about on the webinar today, we are ensuring that we are committing to ensuring good customer outcomes, not necessarily, not only for our customers, but also you guys as well, and our partner networks, because we want to aim to protect you as well from all of this. And what we're really doing is looking to try and simplify our new approach to how we work with you moving forward, just to ensure that there's clarity in the relationship, and ensuring that, not only do we protect the customer, the consumer, the client, but also, protecting protecting our network as well. So, three very simple sort of ways in which we can do moving forward. I don't think that they're a huge um, departure from what we currently or how we currently work with you, but we've kind of labeled them so they're a lot more easily able to be understood, I guess. So first one which we've got is hands-on approach. This is where um, you will advise, place service directly. Hence the reason that they will be commission shared at the inception and renewal, because then of course we can justify that fair value, of course, which means that you will then take full ownership of the client. But of course, alongside that, that you will need FCA permissions, necessary and adequate PI insurance, and of course, compliance around that as well. When we talk about the hands-off approach, this is where you will simply introduce the client to Protect, hence the reason that you have the commission only at the inception, but then Protect will handle everything. So there's no need for you to have FCA permissions. There's no need for you to have that insurance advice on your PI insurance policies. So there's sort of zero admin. It will help you sort of concentrate on the things that you're really good at in terms of the things which make you money as well. Mortgage deals ultimately. So you can sort of benefit from, again, protection. And it's best for brokers who want to maximize their time, avoid those insurance compliance, but also still want to earn commission, of course, because at the policy inception. But we're also introducing a new model, hands-free, which ultimately means that you will introduce the client. Again, Protect will handle everything. There's no commission necessarily paid to you directly, as it were. We're looking to try and introduce the commission for you to keep it and to ultimately sort of pass the benefit back on to the client. So, for example, you could say to the client that we would earn X commission. We want to give that to you as a reduction on your insurance premium, for example. So again, best for brokers who want to try and differentiate and look at a client first, value added service. So very similar to the hands off, I guess, but where you may want to sort of pass that on to the client. A lot more information will be delivered to you around this stuff nearer the time we're sort of looking at introducing it. So the broker support team will be in contact with you on the sessions day, and of course those who aren't and are watching the recording be in contact with you to try and keep you up to date, and there will be necessary literature which will be issued out to you to inform you of the new approaches. I don't think there's too much of a huge departure there. I think it's more around of what they mean to you and how we can help and how we can support you. So, summary and Q&A. So I haven't seen any Q&As or any questions come in that I can see. If you do have your questions, please pop them in and we'll answer them adequately. But I just want to finish off with summarizing our learning objectives, and hopefully we can now understand and define the core principle of that unfair relationship. Connect that legal precedent to the FCA's regulatory requirements on consumer duty, and to articulate how an updated partnership model creates that sustainable framework for future collaboration. So please, if you do have any questions, I appreciate the time, and thank you ever so much for your extra time, and thank you ever so much for registering and attending today. I hope that it will be one of many that you will attend. I hope that you have enjoyed and you have found it informative and useful. We will be issuing the recording for you as well, so if you needed to revisit, and those who weren't who not able to join us on the session. And we will also be distributing this month our very first broker newsletter, which will also incorporate the link for you as well, along with key findings of things which are happening in the industry, both from an insurance perspective and, of course, mortgage advice perspective as well. So thank you, everybody, again. Thank you ever so much. And Cecilia, thanks as well to Jim for joining us on this webinar. Thank you, everybody. Enjoy the rest of your day. And if you do have questions, please pop them in. I'll stay around for another couple of minutes. If not, you are more than welcome to ask the broker support team if you can't think of any questions now, and we'll answer them as we move through. So thank you, everybody. If you don't have questions, then enjoy the rest of your day, and great to have you on board. Okay, I can see the numbers dropping, but I can't see any Q&A. I'll just give it another couple of seconds just in case anybody is typing out any questions, and we'll end the webinar. Okay, right. We haven't had any Q&As in. I'm going to end the webinar again from me. Thank you ever so much. And Jim, thanks for coming on board again. Take care, everyone.